In the world of investment and trading, Nasdaq has emerged head and shoulders above all other exchanges for retail traders looking for high growth opportunities. The potential for disrupting technologies that may redefine entire sectors, along with the possibility of exponential growth in share prices, has encouraged many companies and also traders to begin their adventures here in order to become titans of tomorrow. With companies such as Apple, Amazon, Tesla, and Alphabet, it's normal to see why traders continue to navigate these exciting waters in order to identify a precise way to capitalize on the defining enterprises of tomorrow. After all, this is seen as the birthplace of the modern economy based on the connectivity, speed, and analysis capacity. Amongst all titles that may bring us wealth and prosperity lies Palantir, a data analytic firm based in Denver, Colorado. And Palantir has been an enigmatic company since its inception, with a reputation shrouded sometimes in controversies. As a data aggregator and analysis platform, it has one of the deepest relationship pools with the public sector in the street, entitled to large contracts in healthcare, defense, and intelligence gathering. So its price action is directly linked with the company's own fundamentals, also with the risk appetite of the market at the moment. And with an increasing institutional participation in the company, there may be a lot more potential to where the share price may end up to. Before we begin with today's video, if you would like to see more stock analysis videos like this one, please remember to like, comment, and to subscribe to my channel. Over the past few days, Palantir has continued to hover around the $17.50 level, down by about 5% over the past 5 days and down by around 10% over the past month. These changes are not really significant over the long term, and there are many reasons beyond the fundamentals that can explain it. For one, the end of the year period is relatively calm for the stock market, as there are fewer people trading and there are far less news announcements around. So far, Palantir has managed to maintain its overall bullish tendencies, and we can all agree that the company has had an amazing year given how far it has risen. In the upcoming year, we may start to see some fundamental changes coming from the main street, and given how Palantir's clients are mostly stakeholders in the real economy, it's possible that their individual budgets for research and analysis to be cut. Nevertheless, so far Palantir has proven to the market that it has the capacity to not only be profitable, but to be self-sufficient in terms of cash flow needs. Now, it has managed to serve on the trending topics at the moment, such as artificial intelligence and LLM, large language models. We may never know for sure how profitable those ventures can truly be from a fundamental perspective, but it's safe to say that it has created a momentum in the market. That being said, let's also take a look at the technicals of the stock. The trading volume of Palantir has recently been around 34 million shares, compared to an average volume of 60 million shares. Over the previous 52 weeks period, the price fluctuated between $5.64 and $21.85. The volume of shares traded tells us how many shares are being bought and sold at any given point in time, if there's enough liquidity to cover for a certain particular strategy. If the float is thin, it can be easy to influence the stock price around, but low liquidity could also mean that the demand is limited. When we compare the current volume against the average volume, we might spot the possibility for trend reversal or breakthrough if the difference is very large as well. For instance, if the stock were to break through, the current volume would be significantly higher than the average volume. The market cap of Palantir is currently around $38 billion, compared to an enterprise value of $15 billion. As we compare the current price to historical price fluctuations, the stock is 2% higher than the 1-month low, 26% higher than the 3-month low, and 198% higher than the 52-week low. On the options market, which sometimes gives us a hint about where the sentiment lies, the implied volatility is currently 50% versus the historical volatility of 54%. The put-call volume ratio is currently around 50%. It is normal for many stocks to have a higher put option volume than what they deserve, since many institutional buyers hedge their long positions with put options. The most recent volume of options traded is 191,000 contracts. So this is compared to the 30-day average of 294,000 contracts. Regarding the open interest, the most recent volume of open interest is 3 million contracts, compared to the 30-day average of 3 million contracts as well. Regarding the shareholder structure, institutional shareholders own about 39% of the current float, which is quite significant. Usually, it's always good to see institutional participation when looking for a stock to hold for the long term, because it offers a layer of stability and a token of reliability in the medium to long term. It means that the market is confident that it will deliver value into the long term, which is an important factor indeed. Usually, I would prefer to see stock holding to around 30% in the hands of institutional owners. The current short interest is just around 6% of the total float, and 53% of which come from the dark pools. Usually, if the short interest is above 15% of the total volume and a significant portion of the short volume comes from the dark pools, this may suggest that there are institutional positions taken to short the stock, and then there would be potentials for a short squeeze. Of course, analyzing securities from a fundamental perspective is always helpful, but it should be complemented with extra external forces at play. Investing in the stock market can sometimes feel like riding a roller coaster with its many ups and downs. This roller coaster may seem arbitrary if we compare the company's operational reports and its share price action. It is profoundly influenced by real-world uncertainties, central bank decisions, and many other intricacies between the real economy and the stock market. Even if the end result may differ from their participants, the stock market is deeply intertwined with the pulse of the world, and real-world uncertainties can significantly alter and affect its delicate balance. Events like elections and geopolitical tensions can often trigger fluctuations, leaving investors and citizens around the world alike on the edge of their seats. The mere speculation of a change in political leadership or a brewing conflict can cause stocks to sway, let alone when those speculations turn into the grim, dark reality. If the recent events have shown us anything from an economic perspective, it's quite obvious that the market participants will show less reassurance in the state of the local economy and the stability of our societies. Additionally, we must face the fact that the looming risks of a recession may cast a shadow on the market. When economic indicators hint at a potential downturn, investors may become jittery, leading to heightened volatility. It is crucial to understand that the stock market isn't solely driven by the cold, hard numbers, but also human emotions and perceptions that play a significant role in shaping the market dynamics. We can actually argue that our collective and subjective perception of the future is more important than the objective facts, and that our personal impression from the immediate surrounding can affect our perception of events that happen very far away. And within these immediate surroundings is the central bank, a key player in the financial orchestra. The interest rates set by the central banks have a profound impact on the stock market's rhythm, especially for exchanges like Nasdaq, where the tech companies often dance to a different tone. When the interest rates rise, the borrowing becomes more expensive, affecting the profitability of those companies. For the more speculative tech companies that often operate on the thinner profit margins, or in fact, negative profit margins, higher interest rates can be particularly challenging. Investors may reevaluate the risk associated with those companies, leading to sell offs and increased market volatility. Conversely, the lower interest rates can create an environment conducive to borrowing and investing, potentially boosting the stock prices. One perplexing aspect of the stock market is its ability to march to its own beat, seemingly detached from the real economy. While the economic indicators may point to a struggling or booming economy, the stock market may tell a very different story. This divergence becomes particularly apparent during periods when the real economy is faltering, yet the stock prices continue to rise. This phenomenon can be attributed to a variety of factors. Central banks' interventions, government stimulus packages, and investors' expectations can all contribute to this disconnection. It's essential for investors to recognize the fact that the stock market is not a perfect reflection of the real economy. It is rather a complex system influenced by a multitude of variables. When managing all these complexities, investors are wise to exercise vigilance and to broaden their perspective. Looking beyond the fundamentals of individual stocks, it becomes crucial to consider the macroeconomic and monetary landscape. Understanding how global events, central bank policies, and economic indicators interact can provide a more comprehensive view of the investment landscape. Macroeconomic factors like the inflation rates, the employment numbers, and trade balances should be on the investor's radar as well. Likewise, when keeping an eye on the central bank communications and policy decisions, they can offer insights into the direction of the interest rates and the overall market sentiment. Above these elements, that are all individually important to consider, there is also another one: the idea or the concept of cyclic movement. It is one thing to assume that things will always come and go, the good like the bad, but it's quite another to assume that the next cycle will look exactly like this one. The current market may be towards the end of a super cycle that began with the collapse of the 2008 real estate market and the quantitative easing that followed. A massive amount of capital has been injected in the market for more than a decade, and this has played a significant part in the recovery and later the takeoff of the asset prices. These policies may not come back, and there may not be the same kind of recovery that we have enjoyed after the last market collapse. The past doesn't guarantee the future, and it is no different this time. So really, the stock market is a dynamic and intricate ecosystem influenced by an array of factors. Real-world uncertainties, central bank decisions, often arcane relationships between the market and the real economy all make up to what we see on the stock market. In this ever-changing landscape, investors should be well served by adopting a holistic approach that considers both fundamental analysis and macroeconomic perspectives. By staying vigilant and embracing a multifaceted view, investors can navigate the stock market with a far better understanding of the forces at play. Overall, I would recommend to keep buying Palantir at a slow pace and to accumulate a position in the stock over the course of the next 2 years. If it were to fulfill its potentials, it'll happen in the long term. I would recommend to commit between 3 to 5% of your portfolio and to split the allocation in batches of 20% at a time so that you can purchase more in retracements.